Dividend ETFs are one of the smartest ways to build wealth and create steady income. But not all dividend ETFs are the same. Some focus on long-term growth, others on stability, and some even pay out high monthly income. In today's video, I'll walk you through 5 of the best dividend ETFs that every type of investor should know about in 2025. Whether you're after steady growth, reliable income, or a balanced mix, I've got you covered. So, stay with me till the end, because by the time we're done, you'll know exactly which ETF might fit your portfolio. Hey everyone, welcome back to StockWisp, your go-to channel for clear, honest investing insights. As always, remember this video is for educational purposes only and not financial advice. Now let's dive straight in. ETF number 1, iShares Core Dividend Growth ETF. First up is DGRO. This ETF is all about consistent dividend growth. It's well diversified across all sectors of the S&P 500, with big names like Apple, Microsoft, and Johnson & Johnson in its top holdings. The expense ratio is just 0.08%, which makes it cost-efficient. Over the past 5 years, a $10,000 investment would have grown to around $18,500. With a dividend yield near 2% and 10 years of consecutive dividend increases, DGRO is a solid foundation for dividend-focused investors. ETF number 2, WisdomTree U.S. Quality Dividend Growth ETF. Next is DGRW. Unlike DGRO, which focuses more on stable dividends, DGRW leans towards companies with higher growth potential. That means heavier exposure to technology stocks. The yield is lower at about 1.4%, but the long-term growth story is strong. Over 5 years, $10,000 would have turned into $19,500. This makes DGRW ideal for investors who want growth first and dividend income second. ETF number 3, Vanguard High Dividend Yield ETF. ETF number 3 is VYM, a favorite among investors who want a higher yield. VYM currently yields about 2.5% and has over 500 companies in its portfolio, giving it strong diversification. Its top holdings include Broadcom, JP Morgan, and Johnson & Johnson. With an expense ratio of only 0.06% and steady performance, $10,000 becoming almost $20,000 in 5 years, VYM offers a reliable way to earn income while reducing risk. ETF number 4, Schwab U.S. Dividend Equity ETF. Coming in at number 4 is SCHD, one of the most talked about ETFs in the dividend world. Its current yield sits at nearly 3.8%, with an impressive 11% dividend growth rate over the last 5 years. Although it's faced short-term challenges, SCHD is loved by long-term investors for its focus on high-quality companies with strong fundamentals. Think PepsiCo, Chevron, and Lockheed Martin. With a super low expense ratio of 0.06%, SCHD is great for those who want income plus long-term dividend growth. ETF number 5, JP Morgan Equity Premium Income ETF. Finally, we have JEPI, a unique option. Unlike traditional dividend ETFs, JEPI uses an option strategy to generate higher income. That's why it offers yields in the 7 to 10% range, often paid monthly. However, this comes with trade-offs, slower capital growth, and higher expenses at 0.35%. I personally see JEPI as more of a short-term or side investment rather than a core holding. It's great if you're parking cash and want higher monthly income. So there you have it, 5 very different dividend ETFs for 5 different investing styles: growth, stability, high yield, and even monthly income. The best choice really depends on your personal goals and risk tolerance. Now I want to hear from you. Which of these ETFs do you like the most? And do you already own any of them in your portfolio? And if you found this breakdown helpful, don't forget to like the video, subscribe to StockWisp. Thanks for watching.